What is seller financing in real estate? That has a really big uptick with it. It seems like we're getting a lot of questions about seller financing lately. And that might be for good reason. Maybe it's because of interest rates. People that have assets that want to sell them and they see the current banking's interest rates, they say, hey, I would like to sell my own property and collect interest rates comparable to that. Or maybe it's because they are upside down in the property from a payment perspective. I really don't know. There's a lot of different options that make seller financing potentially a good strategy to go after. And I think if you have the ability just to in one transaction buy a property from someone, I think that is the best thing that you can do. However, in the event that you can't, in the event that you're just getting started, you're not necessarily bankable, in the event that you don't have enough for a traditional down payment and you want to get into some creative financing in real estate to kind of give your business a jump start and grow your portfolio without the burden of the banking regulations, if you're inside that 2 year window, I think seller financing is probably the best strategy available to you if you could talk someone into it. Now, I think if you are looking for seller financing, at the end of the day, it is 100% a relationship. So, seller financing in real estate is when somebody owns a piece of property, albeit land, a single family home, a multifamily, whatever it is, and they hold the note for you. So, you don't go to a bank to get the money, you're asking the seller to finance the property for you. So, if somebody listed the property, let's say it was a for sale by owner, they list the property for $100,000. You say, hey, I'll give you, $100,000 for this property. But what I would like is for you to finance the property. I'll give you $10,000 down and I'll pay you, on a monthly basis. The bank says the mortgage at 7% would be, however much, I'll give you that. So seller financing is you and the seller getting together and figuring out the terms that they're willing to sell the property to you on. Now, there's two main ways of doing this, either via a land contract, which is kind of like the real estate version of layaway. You do not actually get the deed to that property until the terms of that land contract are satisfied. And the second process would look, or the second way to do seller financing is very similar to what a bank would do if it were a traditional purchase, where you would immediately get the deed to the property, and then the seller would have the first position mortgage and the promissory note that outlines the terms of the deal. So, in the event that you have the option that you're able to negotiate which of those two options you should go with, I would always recommend the latter and saying, go ahead, get the deed and get a first position mortgage and promissory note with the seller. That's easier for banks to look at as you're refinancing on the back end. Now, seller financing on a land contract, that is a little bit more tricky and nuanced. Make sure that the title company that you're using is familiar with that process. And then also make sure that everything is recorded appropriately. Land contracts can still be recorded. And in the event that you are the seller and that you have a land contract with someone, make sure that if it doesn't work out, if you take the property back, you have to get that land contract released appropriately. We have recently declined buying some properties because there was some unreleased land contracts. Now, someone has since bought that property with an exception to that land contract. So it's not covered under their title insurance, but that's not something that I would recommend. So in the event you're a seller and you do a land contract and the deal falls apart, the person backs out, gives you back the property, make sure that you get that released appropriately, as that is really important. So after that, the land contract, the promissory note, the main points of seller financing that you should know are the purchase price, the interest rate, and the duration of the note. And the duration, there's two different timelines that you should identify. Most times when people want to do seller financing, there's a balloon payment involved. And the balloon payment means, hey, they're going to finance the property for 2 years, but after 2 years, they want you to pay off the full balance of whatever the terms are. Now, you don't necessarily have to find the full balance to pay that off. You can do a refinance of the property and use a traditional bank, because at this year at that point you've owned the property for 2 years. So you can show the history of that property performing to a lender, and they can see it as more of a safe bet or loan for them because they have 2 years of historic data about how that property is improved. So I would say that is one of the best strategies to use seller financing, is just in a short-term perspective for 2 or 3 years. That way the property is under your control, it's under your care, you're keeping the books for that property. And you're able to then go to a bank and say, hey, this is how the property's performed. It meets your criteria. I'm looking to refinance the property and pay the seller off. That is one of the ways that these contracts have a duration. And the second is the length that it's amortized. So in the event that you are negotiating terms with the seller, you're going to have the purchase price. That's straightforward. You're going to have the interest rate. That's pretty straightforward. And then for the second part of the duration, you're going to want to know if this is an interest-only loan or if it is amortized over 20 or 30 years. So I would say a lot of people are comfortable with it being amortized. That way some of the principal is being paid off and that loan value is decreasing over a couple of years. But for the most part, if it is interest only, then whatever the purchase price is minus the down payment or whatever that is what you're going to owe at the time of the balloon payment if it's an interest only. And that's pretty much it. The only thing that I may have left off is the down payment, like I just said. So purchase price, down payment, the interest rate, and then the duration of this note. And I would suggest anybody starting out, because banks want to see real estate investors be in the game for 2 years or more before they start counting your rental income as income for you to qualify for the loan. So if you have a W-2 job, then the full monthly payment of that loan is going to count against you on your debt to income, because the bank is not going to be willing to count that rental income if you haven't owned properties or been a real estate investor for 2 years or more. So that's important. And in the event that you find yourself in that 2-year window where you have maxed out your debt to income, you can't on paper afford another rental property because they're not counting any of your rental income, then seller financing is going to be, your best friend. And you're going to be able to seek out properties that meet some criteria that would make it to where people are more prone to entertain seller financing. You can seek those out and you can try and negotiate seller financing so that your balloon could be 2 or 3 years down the road. That way, you have that asset producing for you under your control. You're keeping the books for it. You can make everything nice and tidy to fit the bank's mold by the time that balloon payment is due, so that you can refinance, get that seller the full purchase price, and then keep it moving. That's about everything that I could possibly say about the actual structure of seller financing. So the 4 points to go over again: purchase price, the down payment, the interest rate, and the duration. And I'm putting the duration in 2 parts. If a balloon payment is due, like how long from now? Is it going to be 2 years, 3 years, 4 years, 5 years? What is it? And then the second part of the duration is the amortization. How long is that purchase price going to be amortized for? Because cash flow is important when you're going to refinance these. I would suggest a very long duration. We've taken on some properties that are like fully amortized over 8 years. The cash flow is very thin. Now, we did that because the purchase price was so low that we're not going to refinance the property. We're just going to keep the seller financing in place for like 8 years, and then it's going to be a free and clear asset. But it really hampers the cash flow. So in the event that you're a new real estate investor and you are looking to refinance one of these seller financed properties, I would definitely encourage you to negotiate for a very long amortization period up front. That way you can show the most amount of cash flow. Now, the common situations that you should seek out if you're looking for seller financing, I would say any type of high equity asset. So if you see that somebody has purchased a property 10, 15, 20 years ago, then the chances of them having high equity in that property is pretty high, unless you can go through the records and see that they took out like a home equity line of credit or refinanced the property a couple of years ago. And all of this available is very easy to find and very well organized on Propstream. So I will put a link to a free 7-day trial of Propstream. And what I would do with that 7-day free trial to figure out if it's worth it or not is get this criteria, run these different tests, and figure out which properties in your area meet the criteria and try and contact those people. Go really hard. Don't sign up for the free trial until you've got 7 days set aside to where you can try this, test the limits of Propstream, run all different searches, and contact a lot of people. And then figure out if it's worth it. And then keep it. I keep it. I use Propstream a lot because it's so easy to get a massive amount of data and lists pulled of owners that have owned their house for 15 years or more. Right, you're starting to lean on that high equity because a lot of appreciation has happened in 15 years. A lot of principal pay down has happened in 15 years. So the chances of you getting a seller finance deal on that are pretty high. Now you can seller finance a deal on top of a mortgage. So the underlying mortgage, whatever they originally have, that does not have to be paid off in order for you to negotiate seller financing. You're really going to test like the risk tolerance of someone if that's what you're negotiating, because a lot of people don't like having underlying mortgages and then also having a mortgage payment paid to them. But if you can articulate it well, if you explain the process well, that could be an option available to you. You can also, inside of Propstream, pull lists of properties that have no mortgages. Now, sometimes people may have amounts that they owe that wasn't recorded properly attached to these properties. But if it is a cash purchase, if a mortgage was never recorded, then the chances of it being a free and clear property are pretty high. So you can search for all of those. I would look for properties that the person might own 1 to 5 properties and they've owned them for more than 10 or 15 years. That is a good list to pull if you're looking for seller financing, because the chances of them being tired of having rental properties are pretty high, but the chances that they like predictable monthly income is also pretty high. So I imagine with a little bit of work, with a little bit of negotiating skills, you could probably convince that owner to sell you a property or all their properties. So I think it's a solid deal. We have recently, I would say we've purchased 2 packages of properties that were seller financed. One was 11 properties and the other was 13. And we were very appreciative for both of those, as both were a good boost to our portfolio. And remember, and I think this is really important, and if you are on your journey to building wealth, this is a skill that you've already hopefully mastered, or you're in for a really difficult journey. And that's that at every avenue, you should be seeking to add value to someone else and solving someone else's problem. Nobody owes you anything, and you're not entitled to anything. I don't remember who said it. It was one of these kind of larger, cheesier people, but like success, you have to pay your dues daily or something like that, right? Like you're not entitled to anything. One thing that we've been saying a lot in our company, because when we started, it was just my brother and I, and we don't know what we're doing. We're kind of building the plane, as we're flying it or whatever. What got us here won't get us there, right? So if we want to continue to grow, we constantly have to be changing the way that we're doing things and not get stuck in the way that we already have been. So as you're approaching these people for seller financing, they have to have a problem or some type of situation in their life that you need to solve for. It is not, I would not approach this in a cookie cutter way at all. It's all going to be a relationship, and it's all going to be you convincing them that seller financing this property to you is solving one of their problems, and you're a good bet because, and then all the reasons that you have that you're an up and coming person that they should love to help. I would get into if seller financing is important to you, if that is going to help you kind of reach that next level, then I would definitely kind of get into the groove of each time you're looking at a deal, each time you reach out to like a for sale by owner or any of that, ask, would you be willing to entertain seller financing? If you find something off market, ask if they would be interested in seller financing the deal to you. It doesn't make sense all the time, but that is definitely a good way to find them. And then just remember on the back end that once they agree to it, remember it's about you building that relationship, you solving their problem, and you becoming an asset to them, not just draining stuff from them. So I think that's just an important mindset as you're approaching it, because relationships are everything. I would say to go from a place with nothing to somewhere with something. Other people are going to help you get there, and your relationships with them are the most important thing you could probably have.
Thanks for watching that clip. I thought that was a good question. And I think you can ask good questions too. Join us every Friday morning at 8 a.m. Eastern Standard Time for a live stream Q&A where we answer plenty of questions just like this one. In the meantime, consider subscribing to the channel if you want more of this content. And if you want to increase your deal flow, analyze properties better, and help me feed my family, click the link below for a free 7-day trial of Propstream.